Digant Haria, Vice President Research with the Antique Stockbroking, joins us now. Digant, the concerns clearly are well documented for NBFCs, but not every NBFC will suffer and not every NBFC will gain. Separate the men from the boys, wheat from the chaff. In this decline, which category of NBFCs will take it on the chin? Which NBFCs have the risk of slowing the business down significantly, and which NBFCs can survive this one-time reset, so to speak?
Our take is, one that, this is not a NBFC crisis. I think this is a bond market crisis. What we have to understand is, what happened in 2016, the year when demonetization happened, that there is this sudden huge rush of money to the entire mutual fund industry. So mutual fund industry was doing okay, and then suddenly, there's this huge money which came in, and they found out that okay, such a big money to be deployed, and then which is the sector in India which is growing the most. So you had a lot of public sector banks which were under pain, private sector banks, few of them were doing their own things, but two largest private sector banks are also under a lot of pain. So naturally a lot of these money got allocated to NBFCs in general. Now what happens is, then whenever there is a little bit of, this system was not tested on an amount which is as large as 13 trillion rupees, which is the outstanding of all debt mutual funds together. And mind you that mutual funds is something where money is on tap. I can put 5,000 rupees today, take out 5,000 rupees tomorrow. I can put 5 lakhs tomorrow, take out 5 lakhs day after, and so on and so forth. So which is why I think a lot of people are gunning that the NBFC sector needs better regulation. I think the ball has to be put somewhere else. There is a very, very large lender to this system which needs better regulations. So by 2013-14, when RBI ended a lot of the regulatory tightening, mutual funds were very small. Maybe 5 trillion rupees was the debt mutual fund outstanding, and that would be around 5-6% of the system. So at that point of time, it was not thought that there is a very, very tight regulations needed for that sector. But today that sector is 13 trillion rupees, and that's almost 12% of the total outstanding amount of the system, and that is what has created this problem. So that is how we see it. We see this as a problem of the debt markets, a problem of capital markets, and not necessarily NBFCs. NBFCs, what they do is they fill in the shoes which banks have left vacant. Had banks done everything possible and served to the entire need of India's economy, there was no need for NBFCs. But unfortunately, that is not the way it works, and there is a need for NBFCs. Now, some NBFCs have been operating for 20 years. All these South groups, okay, the Sundaram, the Cholas, the Muthuts of the world, they have been operating for 15-20 years, and they have been operating only in the retail or the SME space, as we call it, because that was the space which banks were not very aggressively lending to. Second, there was a class of NBFCs which were born in 2010-11 to take advantage of the PSU bank space slowing down. We all know that PSU bank space faced hundreds and thousands of problems from 2010, and they slowed down dramatically. So you have a 50% of your system slowing down, and those shoes were filled by the NBFCs. Now these new NBFCs found it easier to grow through loan against property or developer loans or structured credit, all these loans which are typically wholesale in nature. So nothing bad with that. That's a need of the economy, and that is what they did, and that is what happened. But the point is that when you are doing this, the risk management has to be very strong. Your raw material supply has to be
no, we understand that, Digant, we understand that. No, thanks for breaking it down to specifics, but I want to get in some very pointed responses from you. Do you think consumer finance, gold loan NBFCs, MFIs would see lower impact? I mean, how do you see NBFCs placed in terms of ALM or leverage ratios?
Number one is, if the debt markets don't normalize, everybody will face a slowdown in terms of borrowings, okay? Be it the best of the best like Bajaj Finances, and be it the ones who are in housing or LAP or builder loans, they are also going to face the slowdown. Obviously, as Nikunj pointed out, somebody will face it more, somebody will face it less. So we think that gold loans comes out as the safest pocket because it is a small ticket lending, it is a small duration lending, and you are lending to thousands and thousands of customers. So automatically your risk profile is very, very low. So in our order of things, gold finance comes as the one who should be the least impacted out of all this. Then you will have microfinance. Again, microfinance is slightly more dependent on banks for the, because microfinance loans qualify as PSL. But on the asset side, we think there is very little problem because, there are lakhs and lakhs of people who repay 1500, 2000 rupees, 500 rupees every month. And that's what makes the economy and that's what makes the model robust. So microfinance is our number 2. Number 3, consumer finance. You have these small ticket loans like two-wheeler financing, consumer durable financing, car financing. So the customer is earning every month and paying every month. So that makes the model very, very robust, that there is some very important use of the assets which the NBFC has financed and customer is earning his best and trying to repay. So I think that as a segment does not have a problem. So our pecking order is gold loan companies, then you have microfinance, and then you have consumer finance. So these are the 3 where we think that impact will be the least. Then obviously there are categories where we think impact will be slightly higher. See, housing finance companies, a lot of us talk about ALM mismatches, but see, we have to understand that ALM mismatches are because we look at the reported data. Now reported data in India does not allow to capture prepayment rates and the unsanctioned bank lines. So most of these housing finance companies have been in existence for 30-40 years, some for 15-20 years. So I think they understand that. So the reality is not as bad as the reported data looks, because reported data misses these very 2 crucial points. So I think housing finance, not everyone is going to face a lot of crunch. In fact, some good players can actually gain market share once the situation normalizes. So in fact, in our report, we say that LIC housing is the best place because aggressive competition will come down, they will have no funding challenges, and they will actually gain some amount of market share. But see, this market share gain does not come in the next 3 months because the entire system is in a risk aversion mode. The market share gain will come maybe over the next 1 or 2 years. But yeah, I think these are the ones who will come out stronger, and we really have to differentiate that NBFC is not just a single universe. There are like 10 or 15 different universes within the NBFC space, and a lot of them have completely different drivers.
Oh yeah, absolutely they do. And thanks Digant as always for joining in and breaking it down for us as to what exactly is this NBFC umbrella about, and where exactly are their problems and where are their opportunities in the current fall. Good to have you on the show as always.